Good morning. This is the Saxo Bank Morning Call for your Friday, September 7th. And we have a lot on the menu today, a lot of an equity focus today, but we'll also be talking dollar, yen, and key stories in emerging markets. As always, a lot of activity there. So if we go to our slide, the big question, we've passed the point of no return, it seems, on this Trump tariff issue. The China tariffs, the $200 billion question, is this going to go into effect today? Yesterday was the deadline for comments or comment on the issue. And there could even be a Japan focus. And Stain, I wanted to actually first go to you on this. You saw some comments potentially that Trump's next step will be to focus critically on Japan as well.
I don't know whether it's going to be the next step, but certainly he's been giving given an interview to a Wall Street Journal journalist, and in that he commented that his relationship with Japan on a political level was very good, and then came the deal breaker. But that's only until I tell them what I want from them. In other words, he is also going to ask for more concession from the Japanese. And I think that is a slight surprise to the market, because the Japanese has signaled that they are under control. They have a very good relationship with Trump. But it seems like, as is always the case with Trump, that friendships last very, 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 very short time, and then they move on. And we've seen a massive move, which I think we will address a little bit later as well.
Yeah. Okay, we've passed the point of no return. Are these going to go into effect today, and how does China respond here on this $200 billion tariff?
So Peter was just asking what's the probability of today being the day. Of course, as you say, the comment period ended yesterday. There was a big lobbying effort from the technology sector yesterday in the White House. But Trump being Trump, I think it's 80% likely we get it today, because he will want to change the agenda for over the weekend. This week has been about his issues about running the White House, how everything is out of control, the New York Times op-ed. So I would expect it to happen during the morning today.
Okay. Great. And if we go back to the slide here, we have a couple of the issues on the agenda here. We have the chips down very heavily. There's some comments from a big semiconductor. It's sort of a service and process control company, so sort of in the bowels, if you will, of the whole production cycle in semiconductors. KLA Tencor, the CFO, commenting about weakness. This saw the stock down 10%. Is this a big worry for you, Peter? I mean, this is a big industry. It's often considered, at least in past cycles, as a big forward indicator for the broader market, semiconductors.
Well, there's already been pricing pressure in the industry for a couple of months, especially in the memory chips. But I would say I'm pretty happy to see what's going on in semiconductors, because I think we have been arguing this since January, when the first tariffs came, or the first sanctions on some Chinese goods. And then we said that cars and semiconductors would be the most vulnerable, because they have the most global supply chain, and they are the biggest components in this trade war. So I think we're just seeing the unfolding events of that. So I think you should underweight the semiconductors for now, and cars still. However, I'm still more positive on the technology, and keep in mind that semiconductor is one of the three components of the overall technology sector.
Right. And that chart I had on that slide was the semiconductor, the SOX, the Philadelphia Semiconductor Index. It was down a couple of percent. Specifically the KLA Tencor, the key driver there. And we also have Alibaba collapsing down a lot. It's down well below its 200-day moving average, and actually the low for a 52-week low. And Stan, you had a comment that you thought maybe it was a sort of a proxy in a way for the whole China trade war situation with the US.
Yeah, it's definitely a bellwether. I think, and Peter can correct me if wrong, but I think Tencent is the most owned stock in the emerging market index. It has the largest weight. But apart from that, I think Alibaba is more of a proxy benchmark for the whole trade thing. And I think early on in the trade talks and the breakdown of the break talks, we saw that Alibaba sort of survived. It had good earnings results. People were buying the model. People thought this is going to be a company that will continue to expand. Now all of a sudden, a couple of weeks ago, we had the results. Ever since, pretty much, the stock price has been going down. And as you show on the chart, I think shortly, it's really breaking down significantly. Of course, this is a stock that's performed over time extremely well, multiples upon multiples of compounding return for the investors. But again, and we have Saxo.
It's off 24% from the high. It's a big move. It's
a big move, and it's very much, to me, an indication. So if you only had one stock to follow the impact of the trade war, I think Alibaba would be my stock to go to in that instance.
Okay, and then rounding out the equity focus, I do have a chart here, if I can find it, of the relative expensiveness of the S&P versus MSCI Emerging Market Index. It's a bit hard to see. This is a retweet of an excellent chart by @Glarus Trading. showing on the left the slightly more short term since 2009 or 10, and then on the right way back to the early 90s. And you see the expensiveness in sort of relative terms. They're calling it 2 sigma rich and even 2.6 sigma rich in the very long term. What's the driver here, guys? Is this trade wars? Is this simply over indexing in the U.S. market? What's the driver of such an extreme cheapness in EM relative to?
Well, I've been writing about it in my monthly equity updates now for 2 straight months, and it's obviously driven by the U.S. being perceived as the tier 1 liquidity pool. So you're not selling off U.S. equities in the first tranche when risk goes up, and then you have the whole dollar and Fed normalization that spills into the sell-off in emerging markets as well with the trade war with China. It also goes out that that's the reason why we did the buy recommendation on emerging markets. We did that a couple of weeks ago, and I did put out in the piece that I thought our timing was probably a little bit too early because there is a high probability that we could have another leg down if we get to $200 billion. But I'm pretty confident actually that the emerging markets will become a quite good and attractive trade versus U.S. equities versus global equities because of that stimulus that's coming from China. We've seen it 2 times. Big outperformance for emerging market equities. It was 2009 and 10, and then 16 and 17. It all came on the backdrop of massive stimulus from China. So I think we're going to see a replay of that.
Well, also on mean reversion and relative valuation metrics.
Exactly.
Yeah.
Exactly.
And it's important to say, just for people who look at portfolio construction, actually mean reversion is one of the few sort of components you can put into a portfolio which is not correlated to anything else, momentum or earnings or anything else. So you have an uncorrelated aspect mathematically of doing these kind of trades where you find something really expensive or really cheap. You're actually buying yourself some portfolio protection by adding what is extremely cheap relative to what is expensive.
We might actually add also that we are in a very unique period where emerging market equities are priced in terms of valuation multiples lower than U.S. equities and global equities. That's not something we're used to. We have seen a period for more than a decade where you always paid a rich premium to get access to local growth in emerging markets, and now we've seen the exact opposite pattern. So.
And that takes us to risk appetite. And I have a great chart here of the yen risk reversal. Stain, this is an issue we've discussed as one of interest with a bigger premium. This is a classic risk-off sign. We have a bigger premium for yen upside relative to downside. And this chart here is I'm trying to remember, it's the 1-year 10 delta, the richness of those puts. How do you read it? We looked at Aussie yen as well. It was even richer premium for buying Aussie yen downside. This is one of these classic risk-off, risk-on types of indicators. How much fear or significance are you reading into this?
A lot, because this is the insurance premium on fire on your house. And what this chart just showed you was that you have to pay 360 basis points to insure your house from burning relatively to not burning, if we want to put the analogy right here.
In other words, the richness of buying a downside scenario.
Everybody's buying the downside, which means that dollar yen will, alone from that fact in terms of the dynamic hedging in the market, will be selling dollar yen. And we tend to... There's an old rule of thumb when I grew up in the market, of course, which was just after World War II. But the fact is that every time the risk reversal, the expensiveness of the option exceeds 100 basis point, there's a gravitational pull from the expensiveness towards the direction of which you're buying it. In other words, that it is 350 is in far exceeds 100 basis point. There is now in dollar yen a negative draft on that. Of course, that can be reversed by other factors. Mr. Abe and Mr. Trump falling in love with each other or something similar. But in terms of the math of this, there is a dynamic hedging aspect, and there is historically a very high correlation between the expensiveness and the directional pull of the move.
Right. And then I think a couple of points on FX. We had some interesting developments yesterday. We had the Riksbank meeting, and I have a chart here of Eurostocky, which it made new highs. Eurostocky above 1070. We have, of course, all this nervousness around the election coming up this weekend. So stay tuned for that on Sunday. Made new highs, has come back pretty significantly from that, above the 1070 level down to almost to 1050, and now we're rebounding despite what I think was one of the more interesting developments, the Riksbank turning hawkish enough to get those yields up a little bit at the front end of the curve, indicating they're going to move to a 25 basis point rate hike in either December or February. Stain, with your Scandinavian background, the Swedish election, we've talked a lot about it recently. it really is key, this outcome for the Sverige Democrat, the Sweden Democrats on Sunday, and how they form a government beyond that, right?
Yeah, so the political uncertainty and the change of the landscape in Sweden is exactly that. You've had two majority parties, or two parties dominating Swedish politics since World War II, the moderate party, the Liberal Party, and the Social Democratic. But now we have a third agent. The third agent is a nationalistic anti-immigration one. And a lot of people perceive this political risk as being a big risk to the Swedish krona and the overall markets. We do know, however, of course, the political risk is always overestimated. I think one surprise we may look at when we get in Monday is that the Swedish Democrats, the anti-immigration party, may do slightly worse than they are in the polls. There is a tendency, at least over the last couple of elections, that they tend to poll 200 to 300 basis point higher. So say right now the market expect them to have about 20% of the vote. If they come in at 17, 18%, I think we could see that due to the cheapness of the Swedish krona, which is clearly evident in the chart you just showed. So
yeah, I agree with that. I think the Swedish krona is a bit underpriced. I think only some really broad-based risk off where currencies are simply punished on weak liquidity could drive Euro stocky higher, or some unanticipated very shock result, 22%, 25% for the Sverige Democrata. We're running on a little bit long here. I did want to briefly get to a dollar ruble chart. A big move in the ruble, 2% lower after Medvedev almost implicitly calling for rate cuts, and this is totally against the tendency in the market, which is looking for rate rises from the Russian central bank due to the pressure on the currency and on EM. So this is almost a Turkish-style scenario without the sort of explicit weakness of Turkey's external deficits, etc. So a big move there. Pay attention to that. Of course, there's the nuclear option of interfering, of sanctions spreading to Russian banks, and that would be a massive further risk to Russian ruble. And Medvedev saying, in fact, that would be a declaration of economic war if those sanctions do go into effect. A key issue there. And then our last chart here before we get to the calendar, Ola, we have some thoughts on commodities. We're seeing all this pressure on EM also spilling into the commodity space, and pretty much what are we, down across the board?
Yeah, I think this tape just gives us a very good idea. This is the performance over the past week, and once again, industrial metals are really on the receiving end of this weakness, because of the combined fact of the strength of the dollar we've seen against emerging market currencies, but also the trade war, which is still really sapping the potential confidence in the market for growth going into 2019. So oil again this week was a question of focus switching from demand to supply and back to demand. The market is still worried about demand growth not living up to expectations into 19, and that's why we're struggling to move above $80 at this stage, despite the fact we got Iranian sanctions coming.
Right. Okay, and then we'll round it off with our calendar for today and for next week. Again, we haven't even talked about, this is payroll day, supposedly the big marquee event. We're not looking at that for specific interest. There's so many big fish to fry on the trade tariff front. I think that's the main focus, and risk on, risk off around that. But we do have U.S. earnings payrolls. Any big shockers, especially on earnings, I think could be picked up. Canadian jobs report also later today. The German industrial production data was weak. And then next week, of course, over the weekend, we have the Swedish election, potentially Chinese response to the tariff situation. And next week, the ECB meeting and Bank of England meeting, no action or major guidance expected there. I would highlight the U.S. CPI as perhaps the key macro event risk of the week. That rounds it up for today's long edition of the Morning Call. We'll see you again on Monday.